Well, the topic that we are going to take up today is financial management. This is a chapter which carries 15 marks weightage when combined with the chapter financial markets. When we look at the chapter financial management, it is broadly divided into 5 groups, main heads: financial management, financial planning, capital structure, financial decisions, management of capital. So in this particular video, we are going to talk about two concepts. One is financial management and the second is capital structure. When we talk about financial management, the core definition says that financial management is concerned with optimal procurement as well as usage of funds. Procurement, we all know finance is the lifeblood of business. You will never find a business which can not run, even start or expand without finance. So financial management is one of the main thing which determines the success of a business. And we always say optimal procurement. Optimal procurement means to obtain, means to get. A business should always try to obtain funds from the source where the cost is low and the risk is less. And once it has been able to procure funds at low cost, it should try to invest those funds into the avenues where the return is going to be higher than the cost. Now, what does this mean? Say, suppose we have a gentleman here, Mr. Ved. Now, Mr. Ved has taken a loan of 2 CR and he has taken the loan at the rate of 10% for his business. Now, what he observes is at the end of the financial year, he is earning a return of 7% on this capital. That means 10% minus 7%, 3% he is paying from his own pocket, which is not a healthy situation for a business. So, a business should always try to procure funds at low cost and also to utilize those funds into the avenue where the rate of return is going to be higher than the rate at which the funds are being procured. Very simple one-liner definition. Financial management is concerned with optimal procurement as well as usage of finance. Now the next thing what we come to is profit maximization the prime objective of financial management? If we look at a smaller picture, definitely we say profit is the source, of earning for a business. It is a reason for a business to survive. But when we talk in the holistic manner, financial management is primarily focusing on the objective of wealth maximization objective. Now, what is wealth maximization objective? The wealth maximization objective means, say suppose this is Mr. Aryan. Mr. Aryan has bought 100 shares of ABC Limited. The market price of a share is rupees 50. So what is the wealth of Mr. Aryan? His wealth is rupees 5,000. Now suppose the market price of this share increases to rupees 70. Now how is wealth going to increase? Wealth is going to increase from rupees 5,000 to rupees 7,000. This is the prime objective of financial management, which talks about shareholders. Who are the shareholders? Shareholders are the owners of the business. So a business should always try to maximize the return to its owners or shareholders. When a business is maximizing profits, it is going to maximize the dividend per share, or the earning per share will go up. When you look at this diagram, wealth maximization is a broader concept and it includes the concept of profit maximization. And although it sets the ball rolling in the sense When the profits will increase, the goodwill of the business will increase. It will be leading to an increase in the market price of the share also. So obviously there is going to be wealth maximization. There is an argument here which says that profits of a company can be manipulated in the short run to pay higher dividends. So we have a difference, tabular difference here between profit maximization and wealth maximization. Wealth maximizing is maximizing the market price of the shares of the company. Profit maximizing is maximizing the dividend per share. Wealth maximization is a wider concept. Profit maximization is a narrow concept. This has a long-term perspective and this has a short-term perspective. So what all we have done, the last topic in financial management is why is financial management considered to be important. So we have got 6 key points here. The first one says to ensure efficient management of cash, to decide about appropriation of profits, how the profits will be disposed of, what portion will be kept as reserves, to determine the capital requirements of a business, both long term and short term, because a business should never be falling short of cash, to determine the capital structure of the company, to decide about the allocation of the fund, what are the different avenues to which the funds will be dispersed, and to exercise overall financial controls to ensure that there is optimum utilization and conservation of funds. So here we have completed all the topics which were relating to financial management. Now the next one is capital structure. Before we move on to capital structure, let's revise and see. Dash is concerned with optimal procurement as well as usage of finance. So what is the concept which is concerned with optimal procurement and usage? It is financial management. The prime objective of financial management is wealth maximization. Wealth maximization means maximizing the market price of shares of a company. The scope of profit maximization is dash, then the scope of wealth maximization. If you remember the diagram, the bigger box is wealth maximization, the smaller box is profit maximization. So obviously it is less. Now here we have got Mr. Sid who is holding 100 shares of ABC Limited. The market price of each share is rupees 60. So what is the wealth of Mr. Sid? Number of shares into market price, which is equal to rupees 600. You can get such a question in an MCQ form also. Now we are moving on to the next concept, which is capital structure. When we talk about capital structure, you know, the concepts in business studies, they always have a clue word attached to here. So the clue word here is a mix. A capital structure is a mix between owners' funds and borrowed funds. Say suppose there are two friends, they are meeting after a long time, and this is say Abhinav and this is Bhanu. So Abhinav is asking Bhanu, what are you doing? And Bhanu says that I am into business. So he says, okay, what is the capital structure? You know, how much money you have invested. So he says, I have invested 10 CR, out of which 7 CR is my own funds, which is the equity coming in. We are presuming it to be a public company. And also 3 CR I have taken in form of borrowed funds. So we can also say, he can say that there is 70% equity and 30% debt. Many a times in the board paper questions, this percentages is mentioned. So which is again telling you that what is the mix. So capital structure also has a one-liner definition. It refers to the mix between owners and borrowed funds. The next concept that we need to understand is capital structure of a business affects both profitability and the financial risk. See, we have done financial management and we say that a profitability of a business is going to be high when it is able to get cost of funds is low. When it is able to get funds at low cost. And when we are given a choice between debt and equity, we would say that debt is a cheaper source of finance. It is primarily for two reasons. One is that there is surety of return. When we talk about the person who is going to lend money, this lender is sure that he will get interest on time, he will get repayment of capital on time. So, because of this surety, the rate of return is relatively low. Secondly is the amount of interest paid is treated as a tax deductible expense. We are going to talk more about this to clarify if this concept is not clear. So profitability of a business will increase when it is going to employ funds where the cost is low. Now when we talk about debt and equity, in case of debt the cost is low. First is the surety of return. So the money lenders, they are settling down at relatively lower rate of interest. The second is that the amount of interest paid is treated as a tax deductible expense. So now what happens when a business is using debt as a source of finance? It is a cheaper source. Amount of interest paid is treated as a tax deductible expense. Debenture holders do not have voting rights. Now, what are the points against the issue? There is a compulsory burden. It increases the financial risk of the business. That is what we are talking about. So, what is financial risk? When we talk about financial risk, it relates to an inability of a business to meet its fixed commitments. Now, these fixed commitments are interest payment and repayment of capital. So, this is what we are talking about when we talk about capital structure. So, this is what is the justification that capital structure affects both the profitability and the financial risk. If we increase the proportion of debt in the capital structure, our cost will reduce. But at the same time, the financial risk will increase because the payment of interest is compulsory and also the repayment has to be done. Now, this is again summing up of why is debt considered to be a cheaper source of finance. The same concept again. So here we are on financial leverage. The leverage means something that is used to take advantage of. The proportion of debt in the overall capital is called financial leverage. Financial leverage, this is the formula you may be asked. When the proportion of debt is high, it is called high financial leverage. When the proportion of debt is low, it is called low financial leverage. Now, what does that mean? If the total capital is 10 CR, we have 7 CR as equity and 3 CR as debt. Or we have got 3 CR as equity and 7 CR as debt. This is going to be this situation. This one is going to be this situation. Now, what we move on to is capital structure. Decision is going to be affected by multiplicity of factors. And when we start with factors which are there, what exactly does the capital structure decision means? If this person, you visualize him as the financial manager and he has been asked to raise 80 lakhs. So what goes on in his mind? Should he issue debt? Should he issue equity to raise this 80 lakhs? What should be the proportion? This is just a hypothetical percentage that we have taken here, 60% and 40%. He knows it very clearly. Debt is a cheaper source of finance, but it involves fixed commitment in the form of payment of interest and repayment of capital. So, first point which is going to be considered is what is the cash flow position of the business. If there is regular inflow of cash in the business, if there is sufficient liquidity, the business can easily meet the interest commitments. That is going to be good, and that means the business should use debt. But if the cash flow position is poor, the business should not take the burden of regular payment of interest, so it should go in for equity. The second one is interest coverage ratio. Now, there is a little simple formula which is involved. Interest coverage ratio is calculated as earning before interest and tax, which is the gross profit divided by the amount of interest. Now, here it says, say suppose a company has taken a loan of 5 lakh at the rate of 10% and it has made a profit of 1 lakh. So when we write 1 lakh is the profit and 50,000 has to be paid as interest. So this is 2 times. Now we could have taken any other example. If the profit was 4 lakhs, then this would have become 8 times. So likewise, if it is a higher, the coverage ratio is on a higher side, a business should issue debt because that means it has got sufficient buffer to meet its fixed commitment of payment of interest and repayment of capital. But if on contrary, if the EBIT was very low, say suppose it was only 50,000. So that means the company is spending its entire profit in paying the interest. So in such a situation, it is not advisable for the company to raise more debt capital. So the company will go in for equity. Now the next one is debt service coverage ratio. When we talk about debt service coverage ratio, it is very similar to the ICR ratio in terms of the interpretation will remain the same. So if the debt service coverage ratio is high, just like ICR is high, the business should issue debt. If it is low, the business should issue equity. So you can always write down the formula also for how this debt service coverage ratio is equal to net operating profits income upon debt service. Debt service is equal to payment of interest plus repayment of capital. Return on investment. A very important point that we have discussed earlier also. If a person is investing 10 lakh rupees in his business and his gross profit is 30,000, so that means he is earning a profit of, this has to be 3 lakhs. So then his profit is going to be 30%. So if a business is making return on investment is on a higher side, a business should issue debt. If it is on a lower side, a business should issue equity. There is again a term coming in, trading on equity, that we have covered in another video. Cost of debt. Now what is cost of debt? A company wants to take loan If the loan is available at 15% rate of interest, this is the cost. If it is available at 10%, this is the cost. So if a loan is available to a business at a lower rate, it is always logical, advisable, a wise decision to depend on debt because it is available at a low cost. That is what financial management also says. We should always try to obtain funds at lower cost. So if the cost of debt is low, rely on debt, otherwise issue equity. The next one is tax rate. Again, an important factor which says that if the tax rate is high, it makes debt cheaper. Say suppose this is the total profit of a business and the business has taken a loan. It has taken a loan on 10 lakh rupees at the rate of 10%. Okay. So the interest here is going to be 1 lakh rupees. If the total profit of the business is 5 lakhs, the business is supposed to be paying the tax only after paying the interest. So that means the amount which it has paid as interest, it is not paying any tax on that. That is what this line means. The amount of tax paid is treated as a tax. The amount of interest paid is treated as a tax deductible expense. But if the tax rate is low, then the business will not be able to take this advantage. Now, in this case, the business will have to pay tax on only rupees 4 lakhs, although the total profit is 5 lakhs. It has got an exemption to pay tax on 1 lakh because that amount is being paid as an interest on the loan that the business has taken. In every factor, we are just trying to sum up on the point whether the business should issue debt or the business should issue equity. The next one is stock market conditions. Factor which affects the psychology of a common investor. Two friends are standing and they are talking, and one of them says that the stock market index is going high. And I think this is a time where I should be investing in stock market. So there is a general perception when the stock market is bullish, when the prices are high, when the index is rising. It really motivates people to invest in stock market because they feel that the people who have already invested are making good returns. So others also get inclined. So that is the time when the company should issue more equity shares because the people are in a push to buy more equity. On contrary, if the market prices are already low, they are falling, the stock index is low. In such a situation, it is not advisable for a business to issue shares. Rather, people will also not be inclined to buy. Although, when we look at the bigger picture, we say that the stock market works on the sentiments of people, and the sentiments of two investors can never be the same. Like, there is this person, Arun here. He wants to sell the shares because the market is bearish, the prices are falling. He is feeling that the price should not fall further, so he wants to sell it off. And here we have his friend Brijesh, who feels, that this is the right time to buy because a share that he is getting for rupees 100 today is not actual less than rupees 150. So that is another factor when we look at in the bigger picture. But how we have to interpret this point is if the stock market is bullish, company should issue equity. If the stock market is bearish, the company should issue debt because the investors are not keen to buy shares. Now we have got cost of equity. This is a point, where we cannot very clearly say what the company should do. It would require little understanding in the background. When we talk about shareholders, Shareholders are the owners of the business, and it is always the owners who are the prime risk bearers. Each shareholder, is willing to assume certain amount of risk because there is a common belief when the risk is high, the return will also be high. So when a business is going to, when will the risk of a business be high? When a business tries to depend too much on debt capital, because debt is a cheaper source of finance, so it is going to reduce the cost, but it is also going to increase the risk. So what you need to be writing here is that under all circumstances, if the debt issued by a business goes up beyond a certain point where the shareholders feel that their risk has increased proportionately, it's on the higher side, they will definitely expect a higher rate of return in order to be getting compensated for the higher level of risk that they are going to assume. So this point we cannot say clearly debt or equity, but it requires this explanation which you need to be understanding and writing in your own words, that equity shareholders are the prime risk bearers because they are the owners of the company. When the risk of the business increases, the return is also likely to be higher. That is a general perception. So when the risk is going to increase, when the business is going to increase its debt component, so the solvency risk is going to come into picture. But increase of debt will reduce the cost. So the shareholders will be agreeing to the fact that the business increase the debt beyond a certain level where they can see that the business is actually going to bear higher risk. In such a situation, they are going to expect a higher return. The next one is a flotation cost. Now, what is flotation cost? The amount that a business spends, when it comes out with an initial public offer. How do you and me come to know that there is an issue of shares in the market, issue of debentures? We come across through advertisements. So who is advertising for that? The company is advertising. The company will get the forms also printed. It will have to arrange for bankers, brokers, underwriters. So this all is going to add up to some expense. It is generally believed that flotation cost should not be 10%, more than 10% of the total issue size. That means if a company is raising 100 CR, it should ideally not be spending more than 10 CR on raising this amount, and it is higher on equity and it is lower on debt. So the explanation of this point, first you need to explain what is flotation cost, then you have to explain it is high on equity because the risk is higher, so we need to be convincing people more. It is low on debt. The next one is flexibility. Now, to understand flexibility, we need to understand, let's say, suppose there is a company here. It has got 4 machineries, 1, 2, 3, 4. It takes the loan, the first loan, and it mortgages this machinery because the loans are always going to be against security of assets. Now he takes the second loan the company is taking, so second asset is mortgaged. Now the more number of assets are being mortgaged, that means if the company has already mortgaged 2 assets, its capacity to raise more debt is going to get restricted. Now it has got only 2 assets at its disposal, so it should always create a buffer, in case a company suffers some unexpected losses and it needs money. That is the time it should be falling on this. So How do we sum it up? We sum it up by saying flexibility reduces when a business issues debt. Too much of dependence on debt is going to reduce the flexibility of business. But there is nothing like this in case of equity. Why? Because no security of assets is required when a business is issuing equity because it is owned capital. So same point here, flexibility is low, issue equity, flexibility is high, issue debt. Flexibility is low and high, it is going to determine on how many assets the company has to be mortgaged to raise debt capital. Now when we move on to the next one, which is risk considerations. The risk of a business, the total risk is primarily made up of two components: financial risk that we have already talked about. If a company has taken a loan and it has to pay rupees 1 lakh rupees as interest and it is not in a position to pay it, the business is said to be facing financial risk. Business risk relates to all the fixed operating costs. So if the business risk is already high, the business should issue equity. If the business risk is low, the business can issue debt because issue of debt, it increases the risk of the business in terms of financial risk. Control. Now, when we talk about control, we are going to talk about, dilution of control. Now, what we can do is, say, suppose there is a person who is doing a business alone. So he has 100% control over his business. He adds on another partner. So now both have got the control. So we say the control has now got diluted to 50%. If they keep adding on maybe two more partners, the control gets diluted to 25%. Same is the case with the equity. Equity shareholders have voting rights. So if a business decides to raise capital through equity, it is going to dilute the control of the existing equity shareholders. But if a business is going to issue debt, it does not have any effect on the control of equity shareholders because issue of debt does not involve any voting rights. There are no voting rights in case of issue of debt. Okay, now we have got this table here for summarization, and also there are 2 points that we haven't discussed till now. When we try to summarize cash flow position, if the cash flow position of the business is good, it should issue debt. Why? Because it can pay interest and it can repay capital easily. If it is poor, it should issue equity. If the interest coverage ratio is high, the business should issue debt. If it is low, it should issue equity. Similarly, if the debt service coverage ratio is high, it should issue debt, otherwise equity. If the cost of debt is low, सस्ते में मिल रही है debt, the rate of interest on loan is less, so it can issue debt. If it is high, it is better to go in for equity. If the tax rate is high, the business should issue debt because it will make debt cheaper. Why? Because the amount of interest paid is treated as a tax deductible expense. If the return on investment is high, if it is low, business should issue equity. If it is high, it should issue debt. Flotation cost is low on debt. Sorry. If the flotation cost is high, the business should issue debt. If it is low, it should issue equity. But in general, it is perceived to be lower on debt than on equity. Cost of equity, we have already discussed that if the risk is going beyond a certain point, then the return to the shareholders needs to be increasing for assuming that additional risk. Stock market conditions. If it is bearish, the stock prices are falling, company should issue debentures, debt. If it is bullish, the stock prices are rising, the company should issue equity. So this is what is all here filled up. Similarly, now when we look at the points, when the risk considerations, if the risk of the business is low, then the business should issue debt because debt will add on to the risk. If the risk is high, the business should issue equity. Flexibility, a business should always, if it is high, that means a business has assets to be mortgaged. If it is low, the business should issue equity. Control, shareholders, existing shareholders do not wish to dilute their control. So the company should issue debt. If they are willing to dilute their control, the company will issue equity. Now, regulatory framework and capital structure of other companies. Two more points here. A company operates within the framework of the laws of the land wherever the company is. So there are provisions under the Companies Act, there are provisions under the Securities and Exchange Board of India Act. So it should has to compile with all these requirements when it takes this decision of capital structure. And also, the last one is capital structure of other companies. It's a very simple perception that we talk about. We can take a very simple example. Here there is a boy. His name is Arav, and he is facing a lot of problem in doing certain questions, maybe certain accounts questions. So what his mother advises him, that you speak to your all other friends and find out how are they trying to learn those concepts where you are trying, you are struggling so much. So when we always look for the experiences, the approach of the other people, if there is a person, this is a shopping complex and a person owns a grocery store here, and there is another grocery store wala here. If he is selling goods on credit, so he would always like to keep an eye and see, how are the competitors, the other people in the same business, their competitors, they are managing the same business. How have they decided upon the capital structure of their company? So this is just for a general know-how as to how the other companies in the similar business have structured their capital. Now here we have got one question from the CBSE sample papers. It's a long case study, as you can see, and when you get a case studies, always make it a point that you start reading the question first before you start reading the case study. It says explain the concept of financial management, and also we have to define the factors. Now as you read through the case study, you are going to come across this point here which says judicious mix of equity and debt. Judicious mix is the keyword for capital structure. So the concept here is capital structure. And what are the factors that we are going to look at? Just to make the things little easier here, it says that within a short span of time, the company could generate cash flows which not only covered fixed cash payment obligations but also created sufficient buffer. So the cash flow position of the company is good. This is one point which is coming in here. It says that the company took a loan which was as a cost of raising loan from financial institution is low. So the cost is coming in which is cost of debt. But this would increase the financial risk of business, which is talking about the risk considerations. Then it says that the debt will, it is going to be control of the shareholders will not get diluted. At the same time, whatever is the rate of interest on loan is treated as a tax deductible expense. So when you look at this case study, you will find that you're getting sufficient clues to be able to answer this question. And likewise, if you refer to the previous year board papers, you will find ample of questions there on various concepts of financial management. As of now, we are ending this video, and we will be looking forward to comments, from all of you, how helpful it has been to you when you were watching this to understand the concepts which have been covered here. All the best.